Good afternoon, everyone, and thank you for joining Commodity Exchange by Barchart, our virtual grain summit. We had a great discussion yesterday on the grain market perspectives panel, and today we're going to cover ethanol, politics, policy, and profitability. And then if you can, join us tomorrow for talking innovation in ag with Barchart's team. Before we get started, just a quick shout out to all of our partners in this event. Had a great panel yesterday and a great panel again today. And the 8 on the screen are the folks that have really helped make this a success. So ethanol, politics, policy, and profitability, the 3 Ps. Today joining us is S&P Global Platts, SIRE, Southwest Iowa Renewable Energy, RFA, the Renewable Fuels Association, and World-Kinect Energy Services. So I'm Michael Browne, head of commodities at Barchart. I've been with Barchart for going on 3.5 years and been in the industry providing solutions to the commodity segment for about 20 years now. So looking forward to a great panel here today. Scott, would you like to introduce yourself?
Yes, good afternoon. Scott Richman. I'm Chief Economist for the Renewable Fuels Association. I've been here for 2 years, and prior to that, I was a consultant for about 25 years and worked with the renewable fuels and agriculture industries.
Okay, Mike.
Yes, thank you. Mike Jerke. I am the CEO of Southwest Iowa Renewable Energy. Been in this role for a couple years and been in similar roles at various companies in ethanol for about the last 19 years.
Okay, fantastic. And Mark.
My name is Mark Novakovich. Thanks for having me today. I come from a grain and energy trading background. And 2 years ago, I joined S&P Platts to help them develop agricultural indexes, promote the indexes, educate clients on how to utilize our assessments to help to manage price risk.
All right, and Andy, please.
Hi, good afternoon. My name is Andy Huenefeld. I'm the Director of Energy Price Risk with World-Kinect Energy Services. For the past 11 years, I've been keeping clients informed of what's happening with energy markets and what we expect to happen in the future, and most importantly, how to protect against that risk. And we work with a number of ethanol clients, helping them manage their natural gas and electricity costs.
All right, very good. Thank you all. Okay, let's dive right in. I'm going to throw it over to Scott Richman first. Scott, when you and I met at the National Ethanol Conference back in February, things were looking pretty good for the ethanol market. There's good momentum around new trade agreements. Corn prices were turning down to $3 a bushel in some areas. Fuel prices were fairly steady. Things were looking pretty good. Could you kind of give us a rundown on what has happened since and maybe where the market stands today?
Sure, I'd be glad to. Yeah, those were the good old days. You're right. It was a very optimistic conference. The RFA puts on the National Ethanol Conference every February. We had it this year in Houston in mid-February, and things were looking up. There were a handful of different things that had been going on that made us look forward to 2020. Going back to last year, we had the E15 rulemaking that allowed E15 to be sold year-round, and by late summer and into the fall, it became apparent that the normal dip in E15 sales that you would see at service stations did not occur. E15 sales kept right on going, and we had 40 to 50% increases in annualized sales of E15. We had the White House biofuels package last fall. That included the higher blends infrastructure incentive program to incentivize E15 pumps, terminals, et cetera. So that was positive. And then right around the turn of the year, there was the China Phase 1 trade agreement. And going back a few years, China was one of our primary export destinations. We're hopeful that there would be a return of China to the U.S. ethanol market. And then right before the conference, in late January, we had a really significant ruling by the 10th Circuit Court of Appeals that tossed out 3 small refinery exemptions. And in recent years, small refinery exemptions have been really a thorn in our side, and that portended a potential substantial scaling back of the exemption program. And the combination of those things made us feel pretty good about this year. We knew, of course, that there had been press reports about the novel coronavirus overseas, but at that point in time, what it meant for the United States was not yet clear. Unfortunately, within a few weeks, it became clear. As you can see in these charts, when in mid-March, when we had the stay-at-home orders that went into effect, especially in some key states for gasoline and ethanol consumption, including California and New York, things just basically dropped off a cliff. Gasoline consumption and ethanol consumption were down at one point in April by 45 to 50%, basically half of year earlier levels. Fortunately for us, we came out of it. It didn't last terribly long at those levels. We came out of it, started recovering in somewhat of a V-shaped recovery as the economy opened back up. But then you'll also notice that since late June, for the last couple of months, we've been plateauing. We've been in the better than being in a U-shaped recovery. We've been kind of a square root recovery, and liquid fuel consumption, or gasoline and ethanol consumption, have been running bounces around, but right at around 10% below year ago levels. We are not back to where we were pre-COVID levels, and I would estimate that losses so far have been on the order of 1.5 plus billion gallons. So it's been a real gut punch to the industry. This is the sharpest downturn the ethanol industry has ever faced. That's the demand side of the picture, and production basically had to adjust to match demand. And you can see from this slide, producers did a pretty good job of rationing back and meeting demand. If you look at domestic consumption and exports combined, I would love to tell you that this was due to great planning and great foresight about the markets. Really, what happened was that the market gave a signal to the industry that you need to cut back, and you need to cut back fast. And that signal was through deeply negative margins, and it was painful. And so we cut back. We avoided the situation that the oil industry got into, where the tanks were completely full, but we had to cut back. We had to cut back pretty substantially. We tried to track as closely as we could what was happening with the industry. About a quarter of the industry was operating back in April at something close to normal operating rates. About 80 plants were completely offline, and another 80 plants were operating at significantly lower run rates. So it was, again, the worst we've seen in the industry's history. If you look at stocks, as I mentioned, we didn't quite get to where the oil industry, petroleum industry got, where they were looking at a lot of difficulty in storing it, but there was some concern we might get to that point. Now we've gotten to where we're just about at 4-year lows, and consumption has come back, mostly come back, as I said. So the stock situation has been cleaned up for us, but we still have some facilities that are offline and some others that are operating at lower run rates. So it's even though this is a better looking picture, it's not normalized. And I'd say lastly, people forget about this, but it's not just about domestic demand and what's happened as a result of COVID. The pandemic and the gyrations that have happened in the markets have also affected export markets. The other thing that's been going on, I made a reference to China earlier. China has not come back. We have had some well-publicized differences with Brazil in terms of trade, and that has also happened with some smaller markets as well. So exports have been a growth area for the ethanol industry, but this year we are running behind on exports just as we are on domestic demand. One of our key export markets, Brazil, has been hit badly by COVID, and there have been impacts, economic impacts, and public health impacts in other parts of the world as well. So we need to recover for the domestic industry, and we also need a recovery internationally in order to get the industry fully operational again. So hopefully that kind of sets the stage for where we are and where we've come in terms of the impacts, where we were at the beginning of the year and the impacts of COVID to date.
That's great, Scott. I think we'll have a few follow-up questions to that from the audience here too as we go along. Some great charts, and I think there's some interesting things in there that I think we'd like to explore a little bit further. Mike, as a major ethanol producer, obviously this has been a tough year. Could you kind of give us a producer's perspective on, how big of an impact this was on your business, how you see things, going forward?
Yeah, you bet. I guess first to start off with some context, Southwest Iowa Renewable Energy, or SIRE, we're a ethanol plant that produces 130 million gallons of ethanol a year normally. But along with that production, of course, is the very valuable co-product. So in our case, that breaks down to about 250,000 tons of dried distillers grains, about 165,000 tons of the wet distillers grains. And then a very important product, of course, is the corn oil, the distillers corn oil, and that's about 43.5 million pounds, all on an annualized basis. And so we do all of that by processing approximately 44.5 million bushels of corn. So, and Scott set it up well. As we went through 2019, a lot of issues that we were confronted with, to include, the export situation. And he showed a good chart there of what ethanol exports have been. But very similarly, that would be reflective of distillers grains. For example, I think in 2018, we exported about 11.9 million metric tons of distillers grains. In 2019, that dropped to about 10.8 million metric tons, and through July, we're off of 2019's low mark by about 100,000 metric tons. So you can see the impact that it has. And our margin drivers are pretty straightforward. It's transportation industry for ethanol and exports. It's the feed industry, distillers grains, and exports. And then, of course, with the corn oil, both transportation and feed to a certain degree. And then aside from that, when you go back all the way to about 2016, the industry has been fighting this ongoing battle over the SREs that Scott mentioned, small refinery exemption. And, that really peaked as we got into the last couple of years. Small refinery exemptions provided by EPA to refineries have worked out to something like 4 billion gallons of production of demand that were curtailed. So that was a headwind as well. So Scott, I was at that conference and we were optimistic, very glad to have 2019 in our review here. But I'm looking forward with optimism to 2020, and and COVID had other plans. So in March of this year, then March 9th, that week, our team was meeting with our all-staff meetings, and we were rolling out what we were first hearing about the COVID situation, as a lot of the companies, and I'm sure our audience was doing, talking to our employees about things we never thought we'd talk about, social distancing, hygiene, and so forth. And within a matter of 2.5 weeks, we were making decisions to drop our rates down to about a 50% rate. And that was the decision SIRE made, taking into account the contracts we already had in place for the products we produce, as well as the corn we buy. And also in our particular instance, some innovations that some capital expenditures that were underway, construction, that we needed to see complete to help meet efficiency goals and targets that we had set. So we came to the decision to go to a 50% capacity, just looking at our variable operating margin. You know, when that's positive, it tells us to run and run hard. And we were in a fortunate position where that was still positive, but the challenge of where to put the product was looming. Fortunately, we did not go to the place the oil industry went, and that received a lot of public attention, but we did proactively go out and procure trackage to put the full loaded tanker cars as, you know, kind of storage on wheels, if you will, and allow us to continue to run at that 50% rate. Doing that, we projected, you know, maybe 60, maybe 90 days, being able to sort of keep that pace up. You know, as we were planning with the team and thinking about how best to attack this, I guess in my head, I was hopeful that 90 days for sure would see us back to something like normal. And of course, no battle plan survives first contact, and what we've come to find out is this is a much longer slog. But fortunately, at rates that are much better than what they were April, late March, April, and through May. So June saw us come back up to essentially full rates, and we've been operating in that world since. The thing that we've been seeing, interestingly, from a risk management perspective, is that you know, for years and years, operating within the spot market in the ethanol world has been the place to be. It's just worked out very well. It's just not a lot of opportunity to shed risk forward months. But the ethanol industry is also notorious for producing too long in the face of economic signals to slow down, and then cranking right back up extremely hard as soon as the sun starts to shine a bit brighter. The COVID situation, though, is different, and we're seeing a different reaction. Now, we can all speculate that balance sheets were impacted throughout 2019, and people were needing to make just capital preservation decisions. Whatever the case, as we've come out of the worst of the pandemic, we've seen more opportunity to indeed lay off risk for sales forward months. And so at our company, we're taking advantage of that. There's so many unknowns. We're sitting with schools starting and you know, kind of lurching through the collegiate sports season, not sure what's on, what's not. And you know, there now more and more talk about fall and a resurgence of what we've seen. And so, again, I don't have a very good crystal ball, but should there be more decisions to shut down or slow down economic activity in order to keep people safe, it's just prudent. It's just very prudent to work with our advisors and you know, and trading partners and put on sales that can keep the company rolling. So you know, that's kind of the size of it. It's where we find ourselves today. Who knows what driving demand is going to look like going forward. We typically talk about the seasonality in our industry. Summer driving season begins typically at Labor Day. And what is that really going to look like going forward? And will we have more of a steady pull during what's normally slower winter timeframes? It's all to be determined. But again, I guess our position is that to the extent possible, we need to be laying off as much risk in order to get through this thing in as best shape as possible. So that's kind of our perspective right now, Michael, and I'd be happy to have questions later on.
Yeah, that sounds great, Mike. There's a great summary. It sounds like operational flexibility in your business is key, regardless of what's going on in the rest of the world. So thank you. Mark, Mike mentioned, you know, the importance and the impact, outsized impact, if you will, on byproducts within the ethanol production process. I think we got a little bit of information here around DDGs and what's happened there throughout the COVID crisis and where things are at today. If you'd like to pick up from there, that'd be awesome.
Absolutely. Thanks, Mike and Mike. Certainly, so Platts is a price reporting agency. We do have what I would consider the benchmark for U.S. ethanol at Argo. Most of the industry trades as a differential to that physical price assessment. And then, of course, we also have the cleared futures contract on the CME, which is settled by Platts for ethanol. About 4 or 5 years ago, Platts, at the request of our ethanol producer clients, decided to get into the DDGs market to shed light and transparency on that feed ingredient as the trade became more sophisticated and as buyers and sellers both demanded some transparency. So currently we're assessing the Chicago or Shanahan DDGs truck market as well as the NOLA market. I would say broadly speaking, we are sort of export focused, although I would say that the Chicago market, the Shanahan market, is somewhat of a barometer for domestic demand and domestic pricing as well, being that it can transload to rail as well as to container. So that's what we're assessing currently. And if you go to the next slide, Mike, I think I'll show you a little bit of a price history. So you can see that during the initial wave of shutdowns, both shutdowns for ethanol production as well as the stay-at-home orders, we actually saw a spike in DDG prices to 4-year highs, really, which is about as far back as our data goes. You know, Shanahan market got up to $225 or close there, and the barge market got close to $245 per short ton. What I would say is I think it's a bit of a truism that food demand and feed demand as a corollary is more inelastic than fuel demand. So while people were shut in at home, stopped commuting, obviously Scott and Mike mentioned that the gasoline and ethanol blending demand collapsed. And as ethanol production was shut in, we saw that feed demand was actually quite resilient domestically and abroad. And that led to the sharp increase in DDGs prices. What I would say is at that point, relative values to other feed ingredients also spiked. I've got a couple slides on relative values a little bit further along. And then DDGs prices sort of, I guess, collapsed or returned back to normal levels that would attract additional feed ingredient blending. As Mike mentioned, exports have become an important component of DDGs demand. I think, roughly speaking, it's about 25% of DDGs production is exported. This year's pace is behind last year's. But I would say that I think what we've seen towards the end of the summer here is we have seen increases in export interest. It's no secret that China's corn import program is the global story in corn exports. The Chinese, if you believe the data coming out of China, the hog population is getting repopulated. I think the numbers as of July were that they were 13% more hogs year over year versus last year in terms of growth. we've also seen some of that in Vietnam and South Korea as well. I would say that Mexico and Vietnam are well-known DDGs buyers. What we've seen this year is increased demand from South Korea, from Indonesia, from Thailand. It seems that the Southeast Asian buyer at the moment is preferring a feed ingredient that's higher in fat, higher in protein. Similarly, we've seen a decline in feed wheat cargo demand into Southeast Asia, and we think that's probably a long-term trend. We think that part of the world is just going to demand a better quality feed ingredient, hopefully when we come out of the other side of this. So we hope that that export portion of DDG's production continues to go up. You know, domestically, I'm sure you guys recall, and the audience recalls, that around that Q2 timeframe, there was a lot of discussion about, you know, wholesale demand destruction, the dining in versus dining out debate. There were, you know, reports in the media of, you know, dairy farmers dumping product and trailers of frozen beef and frozen chicken getting destroyed. But we feel like that was sort of a blip. And as you can see, as we've gone through the summer, DDG prices have rallied because that feed and food demand has been so resilient, and we've kind of gotten back to what I would call somewhat normal, although obviously we're not anywhere back to where we were last year. That being said, you know, the spread to the Chicago and the barge market is something to note. That was impacted this year by the closure of the Illinois River. Typically, the differential between those two markets averages about $18 to $19 per short ton. It's now about $33 to $34 per short ton. Some of the Midwest, upper Midwest DDGs production that would normally find its way to the river to be transloaded to barge has kind of just been sold into the Chicago truck market. That's also enabled some of the growth in container exports this year, but it has come at the expense of bulk exports. So that's going to be something to monitor. And then as we go into Q4, you know, we're going into harvest season. Those relative values to corn are going to be important to watch. You know, historically speaking, we've heard from feed buyers that, you know, once you get up to 135, 140% feed value of corn, the relative value of corn for DDGs, DDG starts to price itself out of feed blends. But what we've seen, at least from overseas buyers, is that they are getting more comfortable with, you know, upper 120, 130% relative values to corn for their feed matrices. And we think that's probably sustainable. Happy to take any questions.
Sorry about that.
Michael, I'm not sure I hear you.
Thank you, Mark. Andy, we've talked a lot about you know, corn prices and ethanol prices and byproduct prices. Could you kind of give us a rundown of other input prices and you know, what we might see there as upside risk going forward around natural gas and electricity?
Sure. So 2020 has been obviously a historic year for a lot of different reasons. But when we look at natural gas and power pricing and deregulated markets, we were at multi-decade lows for a lot of the summer. We saw prices really already very low coming out of what was a mild winter season. The 1920 winter didn't show up until kind of late in the game, and by then the market sentiment was already set. And then we went straight into economic shutdown led by a global pandemic. So we had these circumstances that led to very historically low pricing. And when you adjust for inflation, you can make a case that this was the cheapest year for energy ever in the United States for a lot of the year. And then when we look forward, we've actually got pretty elevated prices for this upcoming winter in the futures market. Right now, winter NYMEX natural gas is trading over $3. That's up more than 30% from the lows that traded back in March. And then when we look at deliveries to a lot of the upper Midwest, specifically to the Ventura Point, which I know a lot of ethanol plants are tied to in one way or another, you tack another 55 to 60 cents on top of that with elevated basis. So the market is showing outsized risk for the upcoming winter. And the reason, from my perspective at least, is that we've had this extended stretch of low prices and we're starting to feel the consequences there. Over the summer, it didn't necessarily matter that domestic natural gas production was off by about 6 to 7 BCF per day. And that was driven by an extended period of low natural gas pricing. But then when we saw crude oil collapse in March and April down to negative for prompt month WTI for a day and a half or so, that brought a lot of drillers out of the field in the Permian Basin and led to a lot of well shut-ins in the Permian Basin. The Permian has been a very important area in West Texas for crude oil output, but it's also been a very important area for natural gas output. And the associated gas coming off of those crude oil wells has really helped to keep the production of natural gas afloat amid about a year and a half of pricing that's below the estimated break-even cost, or break-even price, I should say, for most U.S. producers. So that associated gas was extremely important for our market, and it kept these volumes rising and keeping up with increasing demand from the generation sector, which is actually setting a record in 2020, believe it or not, even with everything that's going on. The structural changes that we've seen with new gas-fired generation units coming online, supplanting old coal units. We're consuming more gas from the generation sector than ever this year. So we need production to continue to grow to meet those structural increases in demand. The reason that the decline in production didn't matter hardly at all during the summer is because we had a congruent decline in liquefied natural gas exports. So LNG exports, mostly from the Gulf Coast, have increased steadily since 2016. Since then, we've added 5 major export terminals. There's one on the East Coast, up in the Northeast, but most of that demand is on the Gulf Coast. Up until this year, that demand was not elastic at all. As capacity came online, we saw export demand rising along with capacity, as most of those terminals were running at full bore. This year was the first time that we saw pricing internationally, specifically in Europe and Asia, get low enough where the counterparties to these long-term contracts that these LNG export facilities were built upon canceled cargoes. So even by canceling cargoes, they're still responsible for a sunk cost. So it's a tough decision not to take delivery and at least try to recoup some of that cost. But we saw pricing at benchmarks in Europe and Asia get to the point where it was pretty much on par with Henry Hub, in some cases at a discount to Henry Hub. So you had all these counterparties say, we'll cut you a check for liquefaction and shipping, but we're not taking your gas. So it stranded all this natural gas in the U.S. that more or less directly offset the amount of production that came offline. So that kept everything in balance throughout the whole summer and kept prices low, kept most deliveries sub $2, which we haven't seen since 2016. And before that, you'd have to go back a decade and a half before we saw any sub $2 pricing in NYMEX natural gas or key regional hubs across the U.S. So that's been the summer. We see that dynamic changing quite a bit, and we're already seeing a significant uptick in feed gas going into these export terminals. And that's in anticipation of October, November, December, and probably beyond, seeing export facilities ramping back up to capacity. Those international margins that got squeezed so tight over the summer are widening back out considerably when we look at winter gas. Just for an example, we expect European pricing over this winter to average about $4.50 per MMBTU. Right now, we've got Henry Hub trading at $3.06. So there's a nice meaty margin there that these exporters are going to start trying to take advantage of. So we expect to see export demand more or less back up to where it was in the first quarter, which is at around 9 billion cubic feet per day, or more than 10% of current supply. So demand is going up, and obviously we have seasonal demand rising as well, with space heating load coming up, introducing just a normal winter risk. But it's going up against the backdrop of a bleak outlook, frankly, for the production industry. We don't see a path to get production back to where it was pre-pandemic, and especially not to continue to grow until we start to see drilling activity pick up. And typically, watching the rig count, which was at all-time lows for a lot of the summer, it's up very marginally from those lows. We haven't seen a change in behavior for oil or gas producers. You could see some level of tapping into drilled but uncompleted wells. you could see some of the shut-in wells coming back online. So that could help things and keep production a little bit buoyed. But to resume growth, we need to replenish these depleting wells. We need to drill more. And right now we're not. So we see this gap where demand looks like it's going to outpace supply. And the market is very much pricing that risk in. This winter, again, is trading right now at about 306. It was as high as 325 a few weeks ago. Next summer, also elevated. This past summer where we had sub $2 pricing. Next summer, natural gas is trading at about $2.80. Then the following winter trading above $3 as well. So right now the market's treating this as kind of a 3-season event. Things start to go down a little bit when you get beyond winter 21-22. But we see the potential in the next, say, call it 12 to 18 months for some fireworks in the natural gas market, which would translate over into the electricity market as well, with a growing proportion of power being generated by natural gas. So, you know, we've all enjoyed low energy prices in 2020, but we do see that potentially coming to an end. And, you know, weather's the wild card. If we get a warm winter, then a lot of this might not matter. But assuming a normal or cooler than normal season, which is entirely possible, we could be in for a decent round of volatility coming up in the gas market. We've already seen quite a bit just over the past 4 or 5 weeks.
Okay, great summary, Andy. Appreciate it. Okay, a couple of roundtable questions that anybody can jump in here. As 2020 begins to wind down, and we look forward to hopefully a much different and better 2021, where does the group see as some of the turning points in the market for next year? What will be some of the key drivers? You know, exports, policy, domestic demand. Scott, why don't we start with you, and then anybody else can jump in as we go from there.
Sure. Well, for ethanol, the renewable fuel standard is still quite important, and one of the things that we have not seen yet that's probably being punted until after the election are what are called the renewable volume obligations for 2021, where the EPA is going to set the requirements for the renewable fuel standard. We also still have to see what they're going to do in terms of implementing the 10th Circuit Court's decision about small refinery exemptions. If we get positive developments on those fronts, that will provide a relatively better environment from a policy underpinning. That's the kind of known that's the known unknowns. Where you get into some risk is, are we going to keep bumping along at 10% under quote normal consumption levels? Are we going to keep on bumping along about where we are in terms of exports? We've got a 90-day reprieve on Brazil. We are still having a tariff rate quota where we've got a certain amount that goes in duty free, and above that there's a 20% quota. That's the more difficult part of the equation to know, is what's domestic demand going to look like and what's export demand going to look like. I think the baseline case is that we kind of bump along like this through the winter, and then there's improvement throughout the rest of 2021. But again, you know, as has been said so often on television, you know, the virus and what governments decide to do about it are going to make that determination. Hopefully, we won't retrench from where we are right now. We'll keep where we are and get to pre-COVID levels during the next 12 months. But we know that we're entering a fairly risky time.
Indeed. Okay, anybody else want to jump in on that?
I think I would just add, you know, from our perspective that, you know, the president made the announcement way back, I think it was January, about a phase 1 deal with China. we're seeing maybe some of the Chinese buying pick up into the other parts of the ag sector, but that'll be one for us to watch as well, to see if that translates even into more of a robust opportunity going forward.
Okay, excellent.
Yeah, the feed side of the world is also highly China dependent. You know, their corn stockpiling program, the estimates vary widely, anywhere from 15 to 30 million metric tons, but their commitment to that program and to their hog repopulating is going to be a major driver. A lot of that's going to be driven by consumer confidence and economic growth in China, where estimates also vary really widely. But there's been rumors. I don't want to share rumors, but it's been well reported that China is considering reducing or waiving some of the anti-dumping duties on DDGs for containerized parcels, at least for now. And so I think that's going to be another important factor to watch as we move into Q4 and Q1.
Okay.
Yeah, and speaking of China, and you know, I talked a lot about liquefied natural gas exports. So just wanted to kind of clear something up that I think it's a big misconception. China is not incredibly important for the current U.S. LNG industry. We've seen new records set every single year. We've seen capacity fully utilized. Everything that's brought online has been fully up and running and spoken for. And China has accounted for a very, very small percentage of that to date. China is important for the next wave of U.S. LNG exports, which is very much up in the air right now, which might come online middle of the decade. But China is not a big driver of U.S. natural gas exports right now. But I think, you know, I touched on a lot of what I think is important for next year. Obviously, the presidential election and the energy policy going forward is going to have implications throughout the entire fossil fuels industry. You know, I don't see anything immediate in that regard. But really, the closest thing that I'm watching is what producers do going into the winter. Do we see any recovery in drilling? Do we continue to see these companies go bankrupt? I think that there's a lot of question about the future of the fracking industry, both for natural gas and oil, because I don't think the price is right now. Looking forward, I think prices long-term are too low to keep this industry sustained.
Okay, excellent. Question on politics with an industry that's just, you know, heavily driven by policy. It's hard to avoid politics, especially in an election year. But could you guys kind of speak to what you see as potential different outcomes depending on which party wins the White House, the House, or the Senate, and what might be some of the biggest differences between the two parties in terms of, you know, really implementing policies that support the ethanol markets? Open for anyone.
Yeah. Well, so it's I think interesting. It's just so understated. The president's support or vocal support of our industry and the farming community is unmatched. But the reality of the situation is that you know, the EPA reports to him ostensibly, and we've been faced with some of the biggest challenges we've seen coming out of their implementation of the renewable fuel standard. You know, again, President Trump has done important things for our industry, but I think there's a lot of producers who kind of left scratching our head, wondering, you know, thank God for an election, right? That there's states like Iowa that are important and represent a significant part of the current administration's base, and you know, thank goodness that's there. But what happens during the next 4 years of a Trump administration, and without an election kind of keeping the focus on us? You know, conversely, you look at the vice president's campaign and what he said, and we were very appreciative of some very positive remarks that he finally made relative to the ethanol industry and his support for where we're at. But there's a lot of open questions. You know, not that there's been an embracing by his campaign of the Green New Deal, but we certainly have been paying attention to those discussions as they've gained traction, at least in some areas. So, you know, and I can't. Iowa sits in a great place, not only because of the caucus, but because of its swing state nature. But, you know, aside from Iowa, you've got some would call Minnesota a swing state. Some would, you know, they point to Wisconsin. All of these are ethanol producing states. And getting back to Iowa, we have a senator, Senator Ernst, who's just been a rock star for our industry, very supportive of ag. But what that's done is made her competitor try to you know, promise or refuse support for the industry. So that's not a bad thing in the event that we end up with a different representative for senator. So it's a real mixed bag. I think a lot of questions that we won't know till, well, we probably won't know till sometime after November 3rd, the way things sound.
Okay, thanks, Mike. Anybody else want to jump in there? Yeah, go ahead, Mark.
I think Mike did a great job summing up. The only thing I would add to that is that biofuels have traditionally enjoyed bipartisan support, and so, you know, hopefully that's something that will continue. You know, there's you know, pluses and minuses with the platforms and the approaches of, you know, of either side, and I think the industry is ready to, you know, to work with those. But we certainly hope it'll continue to have bipartisan support.
Okay, excellent. Very good. We've got about 10 minutes left. There have been some questions coming from the audience, so let's go to a few of those here. First one, Mike, is to you. How has the conversion from ethanol production to hand sanitizer, if at all, affected SIRE or the market, ethanol industry generally? It's been an odd shift to a completely different product, but I'd like to hear your views on that.
Well, it's a great, you know, one of those unexpected outcomes of the situation that the country finds itself in with the pandemic. So, yeah, when you've got a shortage of hand sanitizer, which is made of 60 to 80% alcohol, the ethanol industry sits in a perfect position to help fill that. And SIRE as a company, we took advantage of that. Now, there's a lot of regulations that go into the production of something that's used for, you know, human use. And FDA took a hard look at the risk factors and allowed for ethanol plants, provided that they met certain guidance to get into that market, which again we did. Hadn't expected it. It was a nice, multiple nice, good outcome things. You know, helping the community, donating to the first responders, the area hospitals, other functions like that. But then also being able to supply product in bulk around the country. I think at one point we were up to having delivered product to something like 26 states to try and help fight the pandemic, but also provide a much needed and unexpected cash flow situation. So where we're at currently, our company specifically, is the FDA guidance, the temporary guidance. They have continued to make different iterations in refining that guidance. The latest iteration pushes it much closer to what we would call a U.S. pharmaceutical grade specification. And our company has explored the resources it would take and the infrastructure it would take to get to that level, but we haven't gone down that road yet. A number of other companies in this industry have stepped right up and just pushed hard, and I applaud them for that. So that was again unexpected, you know, unfortunate event, but a nice way for our industry and our company to try and help out.
For sure. And again, we talked about it a little bit before, but operational flexibility, right? Key to survival. Oh, excellent. All right. Another group of questions actually that came in here is, what is the useful life of ethanol? Is it an exportable product? I mean, is it price competitive with fossil fuels, such as fossil fuels, gasoline, and LPGs?
Well, I missed that last part.
Is it price competitive with alternative fuels?
So, well, first of all, I think the first part of that question had to do with shelf life and exportable, and absolutely, you know, the Scott's Barchart did a nice job. The print might have been a little small depending upon your device, but the whole host of countries that we've been exporting to consistently over time. I mean, in normal times, the driving demand, Scott will jump in eventually and correct me, but driving demand would dictate that the ethanol component of that is somewhere around 14 billion in the annual industry. And the industry's been for some time able to produce something close to 16 billion gallons. So that differential, that delta, has to go somewhere, and exports, whether that's Canada, Mexico, used to be China for a while, Brazil's been a great customer, Southeast Asia, and so forth. As it relates to the price competitiveness, I'm going to maybe let my fellow panelists here speak to that. We would argue fervently that it's extremely competitive to do anything domestically, and that's, you know, you can see that in the market pricing for the product. But I'll leave it at that and let someone else jump in here.
I'll just speak briefly about that price competitiveness. Typically, ethanol has been trading at a discount in recent years to gasoline, but there's really two aspects of price competitiveness. One is, you know, people like to look at where's ethanol relative to gasoline. The other is ethanol is primarily used for two things. One is as an octane enhancer, as a source of octane in gasoline. The other is toward compliance with the Renewable Fuel Standard. So if you look at ethanol pricing relative to other sources of octane, typically we're the cheapest source of octane that's out there, definitely in the U.S., often in the world. What's happened this year is thrown things into a little bit of disarray when oil prices went negative in April and dragged gasoline prices and petroleum component prices down as well. That kind of upset the typical pricing relationships, and that hasn't helped with export demand. We've been slowly getting back into a little bit better position. Things like the market movement from yesterday don't particularly help, but over time that situation should correct itself.
Excellent. Another question here is on the standard basis of ethanol for the U.S. Gulf Coast. In other terms, what is the fobbing cost of moving ethanol from the Midwest to Gulf Coast for exports? We have a feel for that on transportation costs?
I don't know that off the top of my head. We do have a Gulf Coast assessment. I could follow up on that, but I wouldn't know that off the top of my head.
I'm in a similar position. I might mention that not to plug any organization, but the U.S. Grains Council does keep a weekly track of Houston prices on their website.
Very good. Okay, very good. Thanks, guys. Here's a question that hopefully the presumptive portion of this is incorrect. It says, when the second wave of COVID hits in the winter, will DDGs jump again? What do you think there, Mark?
Yeah, that's a good question. I think it's going to be dependent on ethanol capacity and ethanol runs, because that's what we saw in Q2 when we saw ethanol shut in. I don't know, Mike can maybe speak more fluently. I don't know if it was 40 or 50% of capacity. That's when we saw the spike because the demand destruction on the feed side wasn't as strong as it was on the supply side. So if we see a repeat of that, yeah, I think it's plausible because I think, I mean, I don't know. I guess the other question, the other component is going to be is if DDGs are sort of inversely correlated to ethanol production and ethanol margins. I guess my question sort of rhetorically would be is, you know, if we stay in this 4, 5, 6, 7 cent per gallon crush margin, is that going to be enough to bring capacity back or not? Or is it going to result in more shut-ins? So I would say it's going to be highly dependent on production. I know it's an ambiguous answer, but that's kind of what I believe. Maybe Mike can speak a little bit to that as well.
No, Mark, yeah, I would have the same sort of opinion as how much more economic slowdown, whatever, are we going to be faced with if a second round comes? And you know, your chart was telling. I liked because that's exactly what happened. Our phones started ringing, as I'm sure every other ethanol producer did, as people started to see the protein equation drop off. And you know, eventually to this, the CO2 production. Our plant, not all plants, our plant happens to be connected to an entity that refines and further processes our CO2 or a portion thereof. And that's the same thing that happened. The phone started to ring and saying, okay, where are we headed with this? CO2, similar to protein, is extremely valuable to downstream people to count on.
Yeah, and the other thing is, I would say is, you know, like this summer, that sort of wholesale food demand from restaurants and from travel never really came back, you know, but the sort of dining in portion that I mentioned, that I alluded to earlier about people cooking more at home, did pick up that slack. And I think that just goes back to the inelasticity of demand argument that I think will continue even through the winter months, even if it's a sort of self-induced lockdown and not a formal national lockdown. I think you'll see that demand relatively steady. So, yeah.
Okay, great. Well, guys, the hour is up already. Certainly appreciate all your participation in this, and thank you to the audience as well for joining us today. Join us again tomorrow, same time, for a look at some of the innovations that Barchart is working on in the agricultural space. And then also, God willing, we'll hope to see you all next year in Chicago for our next in-person event. Thanks again, everyone. Take care.
Yeah. Thank you.
Thanks. Thank you.